Hi Damien. What are you doing?
Oh, hi Carla. I'm doing a little review for tonight's quiz.
Oh, I forgot there is a quiz tonight. Can you explain a little bit about the chapter for the quiz tonight?
Yes, of course I can explain to you. For this chapter, Formulation and Verification of Accounting and the Accounting Theory, you must know the definition of theory. And there are three theory in this chapter, which is Positive Accounting Theory, Normative Accounting Theory, and Agency Theory. Also, you must know the differences between Positive Accounting Theory and Normative Accounting Theory. If you want to know more about this chapter, you can hear this explanation.
Definitions of theory. Oxford Dictionaries 2017 provides various definitions on theory, including a supposition or a system of ideas intended to explain something, especially one based on general principle independent of the thing to be explained. The accounting scholar Henriksen 1970 defines a theory as a coherent set of hypothetical, conceptual, and pragmatic principles forming the general framework of reference for a field of inquiry. The definition provided by Henriksen is quite similar to the U.S. Financial Accounting Standard Board's definition, which is a coherent system of interrelated objectives and fundamentals that can lead to consistent standards. The definitions imply that a theory is the summary and combination of what is known about a field and the reduction of our knowledge to basic ideas, presented in a way that shows their underlying shapes in relationships. A theory is a related set of concepts and principles about a phenomenon, and the purpose of which is to explain or predict the phenomenon. A theory is a good theory if it satisfies two requirements, which is precisely describes a large class of observations on the basis of a model and makes definite predictions about the results of future observations. Accounting is a human activity and will consider things like people's behavior and or people's needs as regards financial information. Therefore, theories are regarded to include consideration of the recommend how assets should be valued for external reporting purpose, which is normative theory. Normative theory is historical cost or fair value. Next, forecast that managers pay bonus on the basis of measures such as profit before or after tax, and will seek to adopt accounting methods that lead to an increase in reported net income. This term related to positive accounting theory. And the third one is predict the relationship between principal, which is shareholder, owner or employer, and agent, which is manager or employee. This term related to agency theory. Accounting theory may be defined as logical reasoning in the form of a set of broad principles that provide a general frame of reference by which accounting practice can be evaluated and guide the development of new practice and procedures.
Positive accounting theory is a theory that attempts to make a good predictions about managers' choice on accounting policies. In positive accounting theory divided into three, which is assumption, efficiency perspective, and opportunistic perspective and hypothesis. In assumption says that managers, shareholders, and regulators, politicians are rational. They attempt to maximize their utility, which is directly related to their composition and to their wealth. And market is efficiency. Efficiency explain about how various contracting mechanisms can be put in a place to minimize the agency theory. Opportunistic is manager will choose an accounting method from within the accepted set to enhance their welfare at the expenses of other party. In hypothesis divided into three, first is bonus plan. Second is debt covenant. Third is political cost.
Next, normative accounting theory. What is normative accounting theory? According to Igeri, Watts and Zimmerman, a normative accounting theory seeks to prescribe some basis of accounting measurement, particular accounting procedures, and the content of financial reports. Igeri views has a special case of deductive theory. Deductive theory that start with some goal assumptions and reduce accounting procedure, therefore are labeled as normative theory. There are two important essentials of normative theory. First, both assumptions, and second, deductions. Normative accounting theory is an optimum model based on ideal world, transaction costs, and perfect informations. The theory is concerned with specifying the decision that should be made as a precondition to considering the information requirement, and focus on decision model which should be used by decision makers seeking to make rational decisions. Normative accounting theory also seen as providing insight into information needs of decision makers as a basis for developing accounting theory. The decision usefulness theory is normative in nature because it made the following assumptions. A. Accounting should be a measurement system. B. Profit and value can be measured exactly. C. Financial accounting is useful for making economic decisions. Normative economic theory is subjective and aims to describe what the economic future should be for a company or investor. As a result, normative accounting practice is a form of value judgment that can introduce subjective morality into accounting. For example, if a company that increased dividend payment could use some of those funds to improve corporate sustainability measures, a normative accounting statement will indicate how much money should be invested in those measures to withstand corporate growth. As I mentioned before, normative theories of accounting are not necessarily based on observation and therefore cannot be evaluated on whether they reflect actual accounting practices. In fact, normative accounting theory may suggest radical changes to current accounting practices. For example, current cost accounting is one of the various alternatives to historical cost accounting that is considered to be most acceptable. Chambers, 1966, had been supporting the valuation of assets on a basis related to their net market or fair value, a treatment that challenged the widespread use of historical cost accounting. Although the fair value for asset valuation has gained popularity in Malaysia since the implementation of FRS 132 Financial Instrument Presentation and Disclosure on 1 January 2006. Current cost accounting differentiates between profit from tradings and those gains that result from holding an asset. Gains that result from holding an asset can be further explained by looking at two components of current cost accounting, which are current operating profit and realizable cost savings. The current cost accounting will be discussed further in the chapter 10. Next, differences between positive accounting theory and normative accounting theory. The differences between positive accounting theory and normative accounting theory. For positive accounting theory, the theory explains and predicts real-world phenomena and is tested empirically. In 1950s, positive accounting theory was developed through some form of deductive or logical reasoning, while for normative accounting theory, the theory prescribes the correct, supposed or best way to account for an accounting event, transaction or practice. Second, for positive accounting theory is the acceptance of rational economic person assumption, which assume that an accountant is primarily motivated by self-interest. The fact that the accountant is rewarded in terms of accounting-based bonus, while for normative accounting theory is not based on observation and therefore cannot be evaluated on whether they reflect actual accounting practices. This theory may rather suggest radical changes. Third, Therefore, positive accounting theory is attempts to justify some of the accounting practices that are deemed useful based in existing accounting practices, while normative accounting theory attempts to justify some of the accounting practices that ought to be adopted. In example, new development like conceptual framework. Normative accounting also deals with future events rather than past data, which is domain of positive accounting practices.
Lastly is agency theory. Agency theory explains how best to organize relationships in which one party determines the work while another party does the work. Agency theory is derived from the positivist theory and is advocated by Watts and Zimmerman as the most dominant accounting research approach in explaining and predicting. In the modern corporation, the separation of ownership from control produces agency relationships between various groups. Jensen and McLean 1976 state that an agency relationship arises where there is a contract under which one party, the principal, engages another party, the agent, to perform some services. For example, decision-making authority on the principal's behalf and rewards the agent with returns. In this relationship, the principal hires an agent to do the work or to perform a task the principal is unable or unwilling to do. The relationship between the principal and the agent under the agency theory can be viewed as follows. First, shareholder and management. Second, debt holder and shareholder represented by management. Third, headquarters and branches. Fourth, parent and subsidiary companies. Lastly, higher management and support staff. Agency problem. Agency problem arise because the principal and the agent are utility maximizers, and there is no reason to believe that the agent will always act in the principal's best interest. This assumption of self-interest in agency theory will lead to inevitable inherent conflicts. If both parties are motivated by self-interest, agents are likely to pursue self-interest objectives that deviate and even conflict with the goals of the principal. The three agency problems are as follows. Risk aversion. There exist different attitudes towards risk-taking between shareholders and managers. Managers prefer less risk projects to protect their job security rather than maximize the value of the firm or shareholder wealth. Dividend retention. Problem occurs when managers prefer to pay out less of the company's earnings as dividends compared to shareholders' expectations. Managers resort to this action in order to retain money in the business to pay for their own salaries and benefits and to increase the size of the empire that they are controlling. Horizon problem. The horizon problem refers to the time horizon interest difference between shareholders and managers, which is linked to long-term bonus incentive. This is particularly a problem if managers expect to stay with the company for a short period of time and are concerned with the performance of the company while they are managing it. After they leave, they will have no interest in the company. Agency loss. To determine when an agent does and does not act in their principal's interest, the standard of agency loss is commonly used. Agency loss is the difference between the best possible outcomes for the principal and the consequences of the acts of the agent. For instance, when an agent acts consistently with the principal's interest, agency loss is zero. The more an agent acts diverge from the principal's interest, the more agency loss increases. When an agent acts entirely in her own self-interest against the interest of the principal, the agency loss becomes high. Agency cost. Basically, agency costs are the ringgit equivalent of the reduction in cash flow experienced by the principal, owing to the divergence of the principal's and agent's interests. In other words, the owners hire the managers to accomplish the controlling tasks of a firm, and as both seek to maximize their own utility and self-interest, a conflict of interest arises. As the managers have effective control of the firm, they have the incentive and ability to consume benefits at the expense of the owners. Jensen and McLean, 1976, defined the cost caused by the divergence of interest between owners and managers as agency costs, which consist of the monitoring expenditures by the principal. Monitoring costs are incurred when the principals attempt to monitor or restrict the action of agents. The bonding expenditures by the agent. An agent may commit to contractual obligations that limit or restrict the agent's activity, resulting in bonding costs incurred by the agent. The residual loss. Residual loss are the costs incurred from divergent principal and agent interests despite the use of monitoring and bonding, as action taken by an agent will sometimes differ from the behavior that would maximize the principal's wealth.
So, do you understand about this chapter?
Yes. Thank you, Damien, for the explanation.